Imagine two paths to financial freedom. One is a digital highway built on the world's greatest companies. The other, a foundation of brick and mortar. Today, we're not just comparing numbers. We're looking at your future. Which one will build your legacy? Index funds or real estate? Stick with me for the next 10 minutes. By the end, you'll have a roadmap that fits your life perfectly. This is the only guide you'll ever need. It's a choice every investor faces, but before you pick a side, you need to understand the DNA of these two giants. First, index funds. Think of an index fund as a massive shopping basket that contains a tiny piece of hundreds of different companies. You're not betting on one company to win, you're betting on the entire human spirit of innovation and growth. It's passive, powerful, and proven. Meet Alex. He likes low stress. He invests in the total stock market and lets time do the heavy lifting while he enjoys his weekends. Then there's real estate. This is the oldest wealth builder in history. It's physical, it's land, it's something you can stand on and call your own. There's a psychological safety in real estate. Even if the market fluctuates, that house is still standing. It has utility and intrinsic value. Meet Sarah. She loves control. She buys properties, manages tenants, and sees the monthly rental income hit her bank account like clockwork. Both are successful, but they are playing very different games. Let's break down the 3 L's: liquidity, leverage, and labor. Liquidity is king in index funds. If you need cash tomorrow, you can sell your shares with a click and have the money in days. In real estate, selling takes months. It's a slow, illiquid process, but for some, that's a feature. It stops you from panic selling during a dip. Now, let's talk about leverage. This is real estate's secret weapon. The bank lends you 80% of the money to buy an asset. If that house goes up 5%, you've actually doubled your initial investment because of that leverage. That's hard to do with index funds. But wait, there's the L for labor. Alex spends 0 minutes a month managing his index funds. He has ultimate freedom of time. Sarah, on the other hand, might get a call at 2 a.m. about a leaky pipe. Real estate can be a part-time job unless you hire a manager. So it's a trade-off. Do you want the passive growth of the market or the active management and potential higher returns of property? Both assets are fantastic hedges against inflation. As prices go up, so do rents and stock prices, keeping your buying power safe. Real estate has unique tax benefits like depreciation, but index funds in a tax-advantaged account like a 401k or IRA are also powerful. Let's talk risk. Markets can crash. Properties can sit vacant. Diversification is your only free lunch in the world of investing. With an index fund, if one company goes bankrupt, you have 500 more to hold you up. It's built-in insurance through math. With real estate, you have concentration risk. If your property is in a town where the main factory closes, your investment could suffer. That's why due diligence is so critical for real estate. You have to know the neighborhood, the laws, and the local economy inside and out. Index funds rely on the 8th wonder of the world, compound interest. It starts slow, but after 20 years, the growth is exponential. Real estate relies on cash flow. You take the rent, pay the mortgage, and keep the difference. You can then reinvest that extra into more property. The biggest factor isn't the asset, it's your temperament. Can you handle a 30% drop in the stock market without selling? Can you handle the stress of a tenant who stops paying rent or a roof that needs an emergency repair during the holidays? If you love data and simplicity, you might be an Alex. If you love people, negotiation, and physical assets, you might be a Sarah. But here's a secret. Many successful investors do both. They use the cash flow from real estate to buy index funds or vice versa. You don't need $1 million to start. Index funds can be started with just a few dollars through many modern apps. And for real estate, you can start with REITs, which are essentially index funds for property, or by house hacking your first home. The goal isn't just to be rich, it's to be free. Free to spend time with family, free to travel, and free from financial worry. That freedom is what we're all working for, whether it's through a diverse portfolio of companies or a collection of local homes. Our mission on this channel is to give you the tools to make those dreams a reality. We're here to learn, grow, and succeed together. You're part of a community of thousands of investors who are taking control of their financial destiny one step at a time. So let's recap. Index funds for passive simplicity, real estate for control and leverage, both for the ultimate diversification. If you're starting today, set up that auto invest. Consistency is the magic ingredient that turns small amounts into fortunes. And if you're eyeing that first property, start your research now. Knowledge is the foundation that prevents expensive mistakes. One major factor to watch is interest rates. Rising rates can slow down the real estate market while often causing volatility in index funds. Both assets move in cycles. Understanding that winter always precedes spring helps you stay the course when things get rocky. Macroeconomics might seem boring, but they dictate the wind in your financial sails. Being aware of the climate helps you adjust your strategy. Let's talk about the silent wealth killers: fees. With index funds, you have expense ratios. Alex chooses low-cost funds to keep more of his money. Sarah deals with property taxes, insurance, and maintenance. These are the operational costs of owning physical land that you must account for. While index funds are cheaper to run, real estate offers more control over those expenses. It's a balance of cost versus command. Sarah maintains a healthy reserve fund. In real estate, the unexpected will happen. Being prepared turns a crisis into a mere inconvenience. Alex uses dividend reinvestment, or DRIP. Those tiny payouts from hundreds of companies automatically buy more shares, compounding his wealth. The goal for both is consistent income. Whether it's dividends or rent, this is the fuel that will eventually fund your ideal lifestyle. Then there's legacy. You're not just investing for yourself, you're building a foundation for the next generation. These assets can be passed down. In many regions, assets like real estate benefit from a step up in basis upon inheritance, potentially saving your heirs a fortune in taxes. Imagine giving your children a head start that you never had. That's the true power of long-term, multi-generational investing. A balanced portfolio might include both. By spreading your eggs across different baskets, you reduce your overall risk and increase stability. Alex and Sarah aren't rivals. They're friends who chose different paths to the same destination: financial independence and peace of mind. Education is your most valuable asset. The more you learn about how money works, the more confident you become in your decisions. We love hearing from you. Which side are you on, or are you a hybrid investor? Let us know in the comments below. Watching your wealth grow is a slow process, but it's one of the most rewarding journeys you will ever take. Every step counts. We've covered a lot in these 10 minutes, from the liquidity of the market to the tangible power of property. Now, the choice is yours. You have the information, you have the community. Now, you just need the courage to take that first step. I know you can do it. The world of the future is built by those who invest in it today. Be a builder, be an investor, be the architect of your own life. The best time to start was 10 years ago. The second best time is right now. Don't let indecision steal your future. You have the power to change your story. Every dollar you invest is a seed for the life you want to live. I believe in your success. If this guide helped you, please like and subscribe to join our community. Your support keeps us creating. See you in the next chapter.